Wow. Thanks so much for the invitation. It's an incredible pleasure to be here. So today we're touching on such a topical topic, stablecoins, and particularly changes in the stablecoin market. So I think to really understand stablecoins, you have to understand eurodollars. So I think there's a lot of historical parallels between stablecoins and eurodollars. So we're going to dig into that, and I think we're going to learn about the future of stablecoins based on the historical lessons from eurodollars. Then we're going to look into the reality of stablecoins today. Crypto's killer app, I think that's unambiguous. And then we're going to look into the future of stablecoins, what's happening, the direction the market's going. So what is a eurodollar? The eurodollar market emerged in the 1950s as a reaction to restrictions in the US banking market and a desire to transact in dollars in offshore banks, mainly European banks. So eurodollar is a dollar-denominated liability of a bank located outside the US. Today, there's more eurodollars than there are onshore dollars, right? So the eurodollar market is bigger than the domestic dollar market. What is a stablecoin? A stablecoin is a normally dollar-denominated liability of an issuer, typically outside the US, which circulates on a public blockchain. So if you actually look at the numbers, most stablecoins are tokenized eurodollars, 75%. Also, the emergence of stablecoins is very similar to the emergence of eurodollars. They emerge for similar reasons. So let's dig into that. Okay, why did eurodollars get created in the first place? So Russia created some of the first eurodollars in French banks in the 1950s. They were worried about the US seizing their dollar assets, but they still wanted to transact in dollars. And so they created dollar liabilities in European banks. Later on, London became the center of this, right? So eurodollars were a reaction to the fear of asset seizures in the US. Okay, why did stablecoins get created? Stablecoins were first created because Bitfinex was having trouble banking, right? They were having trouble settling dollar transactions with their clients. And they decided, okay, well, we don't want to do bank wires every time we want to settle up a transaction with our exchange clients. Let's just deal with the banking system once, and then we'll keep the dollar assets on chain. We'll be able to transact thereafter. So stablecoins emerged due to this fear as well of the US interfering in the settlement rails between crypto exchanges and their clients. Now, of course, stablecoins are much bigger than this, but the key thing that has powered the growth of stablecoins is a desire to transact freely outside the highly politicized and restricted domestic banking sector. Okay, why did eurodollars, why did they grow so quickly in the 60s and 70s? They did because there were restrictions in the US in terms of interest that could be paid. And so the higher yields that were available in European dollar deposits, that grew the eurodollar market very quickly, right? Stablecoins grew very quickly in 2021, 22, because crypto yields at the time were higher than TradFi yields. That's another parallel. More generally, why do people like eurodollars? They're more flexible. You can transact with less restriction, less surveillance. Why do people like stablecoins? Exactly those same reasons. You can transact on an open, interoperable, public transactional space that's global in nature. Next up, eurodollars presented a huge opportunity for certain financial hubs to grow their stature. England, after 1957, the Suez Crisis, the pound was no longer a global reserve currency. England saw the opportunity to become the hub of the eurodollar market, and that massively grew London's stature internationally. Stablecoins, it's an opportunity for specific jurisdictions to grow their clout within the crypto space. We're seeing it here in Singapore, Hong Kong, Bermuda, Dubai. You're still talking about dollar instruments just outside of the US, presenting a unique opportunity for new jurisdictions to compete. And lastly, this hasn't happened yet for stablecoins, but eurodollars were peripheral at first. The US government was fearful of them at first. They were skeptical of them. But after 1973, after the oil shock, after the oil market became very dependent on eurodollars, The US central bank created swap lines with foreign central banks to shore up the euro-dollar market to ensure that there would always be sufficient liquidity in dollars. So ultimately, as that market reached sufficient scale and size, it became geopolitically important for the US to acknowledge it, to stop being fearful, to stop trying to inhibit its growth, and to actually embrace the market. I predict that will also happen with the stablecoins. Right now, the US is fearful of them. They're trying to suppress them. Ultimately, it'll reach a sufficient scale where the US has no choice but to embrace them. Okay, so let's look at the scale of stablecoins today. So I want you to remember this chart, right? So this is the market share of Bitcoin, ETH, other L1s, and stablecoins by market cap, right? Stablecoins today are 10% of crypto market cap. They peaked at 20%. They're only 10% today. Right now, though, if you look at the market share by transactional volume, by the amount of dollar settlements happening on chain, stablecoins are 70 to 80% of all settlement activity on public blockchains. 70 to 80%, right? So public blockchains are all about moving dollars around. That is what we have discovered. That's what the data says. There's some activity on the other L1s, but it's all about moving dollars, right? So stablecoins have emerged in the last few years to be utterly dominant on public blockchains. Now, importantly, as the crypto markets have sold off, as enthusiasm has ebbed away from the markets, stablecoin activity has remained incredibly robust. If you look at monthly active users, it's just up and to the right, even throughout this bear market. So it's decoupled from exchange volumes very significantly. This shows that there's some key utility that's happening with stablecoins that's quite different from the speculative exchange activity in the crypto markets. This is a very important thing to remember. It shows that stablecoins have a utility and volumes that's not necessarily correlated to the market cycles in crypto. I think it's a very important thing to understand. And now, if you look at what stablecoins are doing compared to traditional financial settlement networks, they've almost reached parity with Visa. Last year, Visa settled about $10 trillion. Stablecoins last year settled about $9 trillion. So in the space of about 6 years, stablecoins have gone from nothing to being a major financial settlement network in line with the big leagues, in line with the big guys. So it's a globally important settlement network of consequence. Now, you might be asking yourself, okay, well, is it just for exchange transfers? Like, what are people doing with this stuff? It's actually much more comprehensive than this. Stablecoins are a global financial backend. They power a lot of neobank activity, a lot of remittance activity, a lot of fintechs, especially in emerging markets, especially in Latin America. If you look at the fintech apps, these are mostly LATAM. So these look like traditional fintech experiences, but the whole thing is powered by stablecoins. You're seeing major merchants and global payment processors adopting stablecoins to settle transactions interbank because it's more efficient and faster than ordinary clearing. You're seeing remittance, some of the largest remitters players in the world are now adopting stablecoins meaningfully because it's just fundamentally more efficient than using the correspondent banking system. The problem is, this year, the United States has been extremely hostile to the stablecoin space. It's been a very tough 2023 for the global center of all stablecoins, which is the US. In January, the major financial regulators told the banks they couldn't touch stablecoins. Also in January, they told stablecoin issuing bank Custodia that they weren't allowed to get access to the Federal Reserve. The US basically destroyed important fiat clearing infrastructure which powered stablecoins, namely Signet and the Silvergate Exchange Network. That was a key part of the stablecoin liquidity provision, and throughout the process of the sales of those banks, that infrastructure was left for dead. More recently, in August, the Federal Reserve told stablecoin issuers, or they told banks rather, that, well, yeah, you can, if you get a letter from us, you can do stablecoin stuff. But effectively, it's a prohibition. So unfortunately, in the US, the center of dollar activity, they've been incredibly hostile to stablecoins. Meanwhile, in the rest of the world, you're seeing regulators embrace stablecoins. You're seeing stablecoin legislation getting passed, right? In particular, in Singapore, just recently, you had a regulatory framework finalized for stablecoins that includes the possibility of using dollars. You have Japan lifting their ban on foreign-issued stablecoins. You have Hong Kong allowing for the Hong Kong dollar stablecoin. First Digital, which is a USD stablecoin. So you have this incredible contrast that's happening right now. In the US, you have hostility, fear, and the desire to suppress stablecoin infrastructure. Overseas, it's being perceived as an opportunity. And right now, sitting here in Singapore, it's so apparent to me that there really is a key opportunity, even if we're talking about dollars, stablecoins, not even local currency stablecoins. So if you look at the data again, this is the market cap of offshore stables in the red, and the market cap of onshore stables, as in US domiciled stablecoins, in the blue. They were almost at parity before FTX, almost at parity, right? And then after FTX, after the US launched its attack on the crypto space, which I call Operation Chokepoint 2.0, after the collapse of SBB, which caused USDC to depeg temporarily, you saw the market share of onshore stablecoins decline precipitously, the offshore stablecoins the huge beneficiaries. So US financial policy, their aggression, their desire to suppress the stablecoin space, it hasn't meant that there's been any fewer stablecoins. All it's meant is that stablecoins offshore have been massively advantaged, and US stablecoins have been disadvantaged. Now, I put together a map showing where tokenized dollars are being issued from, and tokenized treasuries as well. So it's pretty incredible, actually, all of the new jurisdictions that have embraced stablecoins and tokenized treasuries. You have the BVI. You have Bermuda, which is a very aggressive jurisdiction in trying to build support and be a favorable location for crypto projects. You have Switzerland, you have Germany, Netherlands, and then of course you have Singapore here and Hong Kong. And then there's some issuers where we don't exactly know where they're domiciled, but we know that they're offshore, right? So the US's failure is the opportunity of these other jurisdictions worldwide, and we're seeing this happen in real time. So what this means is dollars are being exported to the world globally outside the supervision of the US, and treasuries themselves, tokenized treasuries, tokenized yields are being exported to the entire globe. So it's encouraging to see this, but it also shows the failure of US policy on the stablecoin front. Now, another trend that I wanted to talk about is the emergence of crypto-backed USD stablecoins, right? So you could, of course, back the stablecoin with dollar assets, but now it's becoming clear that you're able to back stablecoins with crypto assets. In particular, the fact that Ethereum is now interest-bearing. That means that you have a much larger design space to create crypto-backed USD-denominated stablecoins. So, for instance, there's a project Athena. They created a synthetic US dollar by combining a long staked ETH position with a short ETH futures position, and the whole thing creates a synthetic dollar position, and it's also interest-bearing because both sides of that trade generally pay a positive yield. Additionally, you're seeing staked ETH being used as a collateral for over-collateralized stablecoins, similar to DAI. Many of these are also interest-bearing, right? And so, I think this is a key development because it shows that people are trying to create more decentralized structures that are more stable than the decentralized stablecoins of yesteryear. And the fact that ETH now has this native yield means that you can use ETH to create a USD stablecoin. Of course, these projects are also more outside of the reach of US regulation, which shows, I think, this is a reaction to US regulatory winds turning extremely hostile. So with all of this in mind, right, we've talked about historical parallels in the euro-dollar market. We've looked at the data. We've seen that stablecoins are the prime killer app. They dominate from a transactional perspective on public blockchains. And we've looked at some new types of projects emerging, yield-bearing stablecoins. So let's make a couple of predictions. So right now, the US dollar is the unit of account for 99% of all stablecoins plus. That's obviously much more than the US dollar share of international foreign currency reserves or international trade. It's pretty remarkable that stablecoins are so dollarized, but they are. So I would predict that would continue to be the case, that they would maintain at least 95% market share in terms of stablecoins being dollar-denominated specifically. Next up, we have the emergence of interest-bearing stables. So right now, stables basically don't pay interest. And you're talking about 550 basis points of opportunity cost. The fact that major stables don't pay interest, I think, is what has caused a lot of the contraction in the stablecoin sector. So now that there's interest-bearing stablecoins that exist, I think you're going to see immense disruption in that market, and the incumbents are going to be forced to start to pass some of that interest along to the holders. It's just not technically difficult to do. There's no reason they shouldn't do it. That's going to happen. However, interest-bearing stablecoins cannot really be issued out of the US, so this is another trend that's going to accelerate the offshoring of stablecoins. For regulatory reasons, interest-bearing stables are probably going to have to be issued offshore, and that's what we're seeing so far. Next up, we're going to see the rise of crypto-collateralized USD stables. And I think this is a great thing because you're harmonizing crypto assets as a store of value and stablecoins as that medium of exchange, right? So it's a very crypto-native thing, and it kind of unifies our goals here. So I think within about 2 years, you're going to see 25% of USD stablecoins being issued against crypto collateral, not dollar assets. Today, it's less than 5%. Next up, the dollarization of public blockchains, right? Basically, public blockchains are all about moving dollars around, as I said. I think you're going to continue to see that happen. There's good tax reasons why it makes much more sense to transact with a stable unit of account as opposed to volatile crypto collateral. So I think it's very fair to guess that that's going to continue to be the case. And lastly, and this kind of ties everything together, crypto euro-dollarization, right? So people do want USD stables, but the US is a hostile place for them right now. And you're going to continue to see those USD stables being issued overseas in places like Singapore, Hong Kong, Bermuda, Dubai, right? Because entrepreneurs have that desire to create these products and create valuable experiences for their clients, but right now they're stymied in the US. And this is my big prediction, again, taking it back to Eurodollars. Once that market reached sufficient size in the early 70s, the US central bank had no choice but to create swap lines with their counterparties in the Eurodollar market. If you look at inflation adjusted, the stablecoin market is the equivalent of 1967 in the Eurodollar market, right? So we haven't quite reached that inflection point in terms of stablecoins. It's only $130 billion worth of stablecoins that exist. But I think that will come. And the challenge to the crypto community is to continue to integrate stablecoins into global settlement infrastructure, create something that's so compelling that the governments of the world have no choice but to fold those markets in and to acknowledge them as legitimate. So I want to thank my data partners on this presentation, Coinmetrics and Allium. You've been incredible. And thank you to the organizers for the opportunity. It's been my pleasure.